We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Last week, I did a live Q&A session for a variety of corporations that offer financial wellness to their employees through BrightPlan. As a quick background, BrightPlan is a total financial wellness solution that provides customized financial education to companies and their employees, digital financial planning with access to human advisors, automated investing to build wealth over time, and tools to manage your financial life. Our team works really hard to democratize fiduciary financial advice, and it's so much fun to interact directly with employees in events like the one we had last week. Today, I'm going to answer some of the questions that were asked and tackle a few questions that we didn't have time for. As always, you can find show notes and resources at thelongterminvestor.com. Plus, you can submit questions at the bottom of that page and sign up for my newsletter to receive all of my latest insights and recommendations from what I've been reading recently. Let's dive right in. First question, how do I protect my savings against inflation? Historically, stocks have outpaced inflation by a wide margin in the long run. During inflationary environments, corporations pass on higher prices like wages, input costs, etc., to consumers, which in turn boosts revenue and earnings. Going back to 1928, both U.S. dividends and earnings have grown roughly 5% a year, while inflation has averaged about 3% a year. And sure, stock returns are below average in years when inflation is rising or is above 3%, but over the long run, they are far and away the best way to protect your savings from losing their purchasing power. This is a really good question that seems to be on a lot of people's minds right now, especially since last week, the U.S. Labor Department reported that inflation was 7% in 2021, the highest in 39 years. You don't need to be an economist to realize that this headline is a big deal for Wall Street and Main Street. But as someone who works on Wall Street and lives on Main Street, I'm here to tell you that I'm not particularly worried about the recent uptick in inflation. Here's the thing. Inflation is already here, and there's nothing you can do about it. Trying to hedge against something that has already happened doesn't make a lot of sense. Inflation has historically averaged 3%, but that naturally includes times when readings fall below that level, as it has for most of the past 2 decades, and times when it's higher than average, as it is today. The way I think of it is that we're simply witnessing inflation following its winding path to an average outcome. Inflation's path takes far fewer twists and turns than, say, stocks do on their path to an average outcome, but it's still easy to notice big shifts. And while 7% inflation in 2021 is obviously very high, I'm not saying it isn't high, but it seems extremely unlikely to persist. Yes, if we had 7% inflation for multiple years in a row, that's going to be harmful to the economy. But there's signs in the economic data that inflationary pressures are cooling. Plus, the Federal Reserve has telegraphed its intention to tighten monetary policy to choke off inflation, even if it's at the expense of short-term labor market health. Next question. What advice do you have for someone just starting to invest in cryptocurrency? Let me be 100% clear before I answer this question more directly. I am not anti-crypto. I think some people assume that based on some of the content I've published over the years, that might be the case. But I've actually been pretty consistent in my opinion on cryptocurrency from the beginning. One, cryptocurrencies are fascinating, and the basic idea is wonderful. 2, the range of potential outcomes is enormous. And 3, arguably most importantly, your financial plan's success is unlikely to hinge on whether you do or don't own cryptocurrencies. Most recently, I published an article when Bitcoin prices were peaking, as well as a podcast when the first Bitcoin ETF came to market that really pushed back on some of the false narratives and faulty reasoning people used. Now, that doesn't mean I dislike crypto. I just dislike nonsensical investment logic. So with that disclaimer out of the way, here's how I would think about investing in any exposure, not just crypto. The starting point for a discussion on a new portfolio exposure ought to be its relative market weight compared to your other portfolio assets. For example, the global stock and bond market is roughly $200 trillion. Bitcoin's market value is nearly $1 trillion. As an asset allocator, my starting point for this discussion would be roughly 0.5% of the portfolio. That's 1 trillion divided by 200 trillion. Now, there's more to the crypto space than just Bitcoin, so maybe you allocate more than that. Or maybe you allocate less because there's some degree of uncertainty that it will improve risk-adjusted returns. And the uncertainty at this point is in large part due to the small and noisy sample of the historical data. There was similar uncertainty present when emerging markets or REITs were first being added to portfolios. But either way, I'm in the camp of starting small in total allocation, if at all. Now, as for how much to allocate to specific coins, I approach this using the same framework as investing in individual stocks. There is no compensation for taking on the idiosyncratic risk of an individual stock. So I would say that you should limit your total individual stock exposure to 5%. And buying an individual coin is very similar to buying shares of Apple or Amazon or whatever. It's a specific bet, and specific bets ought to be limited. Next question, any tips for investing in uncertain times? Well, the future is always uncertain. There are risks inherent in that. But that's the reason you earn a decent return in investing in stocks. Uncertainty and volatility of returns is the cost of higher expected returns. My advice is to plan on downturns occurring with a similar magnitude and frequency as they have in the past. Last time I checked, the S&P 500 averages a 10% downturn about every 12 months, 20% downturns about every 3.5 years, and 30% or more downturns about once a decade. Rather than try to predict when or why a downturn might occur, it's far better to simply plan on them occurring. And that's how we build our financial planning models in both BrightPlan and at PlanCorp, which to me makes rational sense because probability is the only rational way to make decisions about an unknowable future. So that's my best tip. Plan on downturns occurring. That and stay the course when things feel uncomfortable. Next question has a number of questions bunched together. This person asks, how much is too much when it comes to expense ratios? Should I be worried about the fees associated with the funds and the fees that are charged by financial advisors to manage my funds? How big of an impact do they have in my long-term investment goals? So a few questions here. Let's tackle them in order. According to Morningstar's annual U.S. fund fee study, the asset-weighted average fee is now 0.41% or 41 basis points as of 2020. So that's a nice benchmark for fees, but it also matters what a fund's strategy is. For example, 41 basis points is way too high a fee for a broad market index fund. It's maybe even too high of a fee for a systematic strategy like a factor fund or ESG portfolio. But some funds do charge higher fees because it costs more to execute their strategy. And it's totally fine to pay more in fees if you're getting something of value. But I think that weighted average fee is a nice benchmark, maybe for your portfolio as a whole. I can speak from experience in that the portfolios we manage at PlanCorp and at BrightPlan tend to be closer to 0.2% or 20 basis points. if they're anything other than a pure index portfolio. Pure index portfolios, those have costs in the single-digit basis point range. Now, as for advisor fees, what services you receive will really define whether you're paying too much. If you're paying a fee equal to 1% of the assets being managed, and you're only getting investment advice, I'd argue that's way too much. You can get investment advice for 0.25% from a robo-advisor. And I really emphasized this point in the presentations last week because all of the employees had access to the BrightPlan platform, which manages investment portfolios for that rate. Now, if you're getting proactive, comprehensive financial planning advice and being charged 1% of your assets, then I'd say that's pretty fair. I'm not arguing that it's cheap, but I think that a good advisor is worth their weight in gold. I have an advisor myself, so I follow my own advice on this one. Now, to answer the final part of this question, how big of an impact do all these fees have in your long-term goals? With fund fees, every dollar you pay is a dollar of return you don't keep for yourself to compound. You could make a similar statement about advisor fees. Every dollar you pay is a dollar of return you don't keep compounding, but I think that misses out on the function of an advisor. Financial professionals are trained to manage money, yes, but we're really managing humans. Money is easy to conquer. Humans are complex. In a recent essay of mine, which I'll be sure to link to in the show notes, I compared the management of humans and their investment beliefs to how executive coaches or therapists might help individuals navigate their natural human tendencies. Besides providing general support and encouragement, those professionals play a key role in identifying blind spots. They say things out loud that others are probably thinking, but don't voice for some reason or another. In many ways, that's what I do in client meetings. I support and challenge. The immediate impact is often subtle, but over time, even the tiniest shifts in direction on a compass will lead you to an entirely different destination. Not only does an advisor impact your long-term investment goals through ongoing redirections and interventions, but it's also not uncommon for a financial advisor to earn a lifetime of fees by preventing a client from making a single mistake. Cognitive and emotional challenges manifest differently for everyone. My advice is to find the person that can help you uncover your blind spots and advocate for your best interests. That is the person who will be worth their weight in gold. Next question, what are some resources you go to personally to learn more about investing? For me, the best learning comes from reading books. And there are two lists of books that I've compiled that you may find useful. I'll link to them both in the show notes at thelongterminvestor.com. The first list is called 22 Books That Will Make You a Better Investor. And the second one is called 5 Personal Finance Books That Influenced My System for Building Wealth. So go ahead and check those out at thelongterminvestor.com. I also find myself listening to a lot of podcasts, the ones that are more investment-centric. I think Rational Reminder, Animal Spirits, Washington Wise, Invest Like the Best are all really excellent options. Again, I will link to all of those in the show notes. And if you're looking for something more retirement-specific, the Retirement Podcast Network has several shows that I think are really good, again, that I'll link to in the show notes. Blog-wise, I use Abnormal Returns to aggregate all of the best content out there. So that's really one of the few blogs that I go to every single day because they're drawing from the entire internet. That way I don't have to run around myself. The other blog that I go to almost on a daily basis is Collaborative Funds blog, where Morgan Housel writes on a pretty frequent basis. I will link to all these things in the show notes, but those are some of the places that I use to enhance my own investing learning. Next question, what are the best ways to begin investing to take advantage of compounding wealth? I think the best place to start is your employer's retirement plan. And for most people, that's a 401k, a 403b, or a 457 plan. Definitely start here by investing up to the match because that instantaneously doubles your money. So if you want to take advantage of compounding, then starting out by immediately doubling your money in a tax-deferred account is a pretty strong move. Another kind of beginning question we had here is, should I trade in a demo account first to learn about investing or jump right in? Well, I'm going to focus really intently on the word, quote, trade here. This person's asking if they should trade, not should they invest in a demo account first to learn. If you're truly just starting out, again, I urge you to use your employer's retirement plan. I don't think it makes sense for you to open another account to make trades if you aren't maxing out your retirement plan. Investopedia has a really good stock market simulator that I can link to in the show notes. That could be a good place to learn about trading, but know that trading isn't easy. Winning for a few months or even a year or two is not indicative of how you would fare over the long term. If trading were easy, nobody would need to work. And when you're in a bull market, particularly like the one we're in now, it makes trading look much easier than it really is. Now, if you insist on having a trading account, then I usually guide people to fund it with an amount of money you can afford to lose. Ideally, no more than 5% of your total investments. If you lose it all, do not add to it. If you end up performing well, do not add to it. Look, if there was a consistent way to beat the market trading individual stocks, somebody would have already won a Nobel Prize for it. Next question. How should someone deal with risk for shorter timelines, i.e., people close to retirement? When you're approaching retirement and your financial house is in order, the primary concern is usually what we refer to as sequence of return risk. This is the risk that you experience a bad string of returns at a time you're initially making withdrawals from your portfolio. If the stock market is down in the first couple of years of retirement and you make withdrawals at those depressed valuations, then you permanently impair the earnings potential for your portfolio over the course of your lifetime. And naturally, there's going to be downturns during retirement, but this is really just a focus on the first few years of retirement. One way to mitigate this sequence of return risk is to have a year or two of cash on hand that you can use to meet living expenses during a downturn early in retirement. That way your portfolio can have more time to recover. Now, a somewhat related topic, but not exactly what the question was asking, is that many of the retirees we work with, they reach a point in retirement where they clearly have enough assets to fund their ideal retirement and some. So they start viewing some of the assets as actually having a time horizon aligned more closely with those who are likely to inherit it. And the result is that as people age in retirement, it's not uncommon for them to actually ramp up the risk in their portfolios. The final question we had here is, do small cap or mid cap stocks make sense in 2022? Well, I have no idea if those will be the best or worst performing asset classes or something in between. But I do think that everyone ought to have broad market exposure, which does include small cap and mid cap stocks. Just for perspective, we utilize 3 different strategies at both PlanCorp and BrightPlan, depending on an investor's objectives and constraints. Those 3 portfolios are the index portfolio, the factor portfolio, and the ESG portfolio. The index portfolio seeks to own the entire market according to market capitalization. So in that sense, it makes sense to own mid-cap and small-cap stocks in proportions according to their market weights. The factor portfolio actually does overweight mid-cap and small-cap stocks. Even though that portfolio has broad market exposure, it gives greater weight in the portfolio to a handful of portfolio characteristics that have historically exhibited higher expected return. And one of those characteristics is size. That factor can most simply be explained as small companies tend to have higher returns than larger companies because they're riskier. Now, the ESG portfolio we provide has fairly similar mid and small cap exposures as the index portfolio. And with this portfolio, it's more about overweighting companies that do a relatively good job addressing environmental, social, and governance issues. So in all cases, across all portfolios, mid and small cap stocks play an important role within a globally diversified portfolio. That's all I have for today. Again, please go to thelongterminvestor.com to find show notes and resources, as well as a place to submit questions for a future episode of the podcast. You can also sign up for my newsletter, which comes out twice a month and highlights the things that I have done most recently, as well as the resources that I'm currently reading that I think that you'll find interesting. Go ahead and check that out. But until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.